Zillow says prices go up 1.2%. Fannie Mae says 3.6%. And one analyst is even calling for a 50% crash, worse than 2008. There are a lot of predictions for 2026, and we don't agree with each other. Let's fight about this.
Well, I think I'm right. Mitch is wrong. And that's a short episode, right? I mean, real estate, we've seen, there's ups and downs over time. I think it's going to go up. What's going to happen in 2026? That's tough also because it is market specific, right? But if you're taking a national trend where you have puts and takes in different markets, I mean, I think we're now at a point where, at least according to some of the data you're reading, maybe this is politically skewed, that the cost of living or wages are outpacing the cost of living finally for the first time in several years. So does that mean people can afford more mortgages? Our mortgage rates are down now, so there's more affordability and purchase power with buyers? I think so. But I think ultimately it comes down to the fact that our wonderful government on both sides of the aisle print a shitload of money. They create a lot of capital. They pump it into the market. And if you own assets, values are going to go up, whether that's a single family house, whether that's a duplex, or whatever the case might be. Rents go up if you're owning rental properties, which subsequently increases the value. So I think mortgage rates, I think the fact that you've got inflation kind of getting under control, finally wages are keeping up or outpacing. I think all of those things put me in a bullish position for the market. So expect nationally, I think that values are going to go up.
Well, I mean, I'll take the bear case because I think that you're in one of the hardest times in history to pay for medical, hardest times in history to pay for groceries. Every single major expense of families has grown times 2 over the last couple of years. When you hit inflation, it hits every single area of a family's spending, including housing. You talked about inflation increasing prices, which is true. That creates, makes housing more unattainable. That, intersecting with more and more of a renter's economy, I think that could also, create a situation where housing prices go down. In other words, buyers, aren't moving off the benches. We've seen interest rates drop in the last couple years or the last year or so, and housing is still basically dead in most markets. There's very, very little transaction volume, showing that there's a bigger delta from buyers' expectations and payment ability and in current sellers' prices. So I think that we've discounted Main Streets bleeding in a high inflationary environment, and the rise in the cost of living and what that does for saving for down payments and actually getting into the housing market.
Okay, but I have multiple questions here. So for one, don't you think this is hyper localized? I mean, as far as, yes, we can nationalize this stat. The real estate market's going to go up, it's going to go down, it's sideways. Like, I've never cared that much because I think it's very market specific. So for one, I'm curious for both of you, like, do you care nationally what that looks like? And then also, do either one of you actually believe that we're going to have any scenario where prices come down 50%? We're going to have that's bigger than 2008. Do you guys really think on a national level or even a local level we're going to see that?
No, because I think you have a supply and demand imbalance still. I think you do have absorption happening still from overbuilding in a lot of markets. I think once that absorption's done, you generally have a housing shortage, right? I think there's a general housing shortage. So I think,
is there though? Is there a housing shortage?
I mean, again, depending on all of the statistics I've read, that we're in sort of the maybe middle to tail end of absorption in a lot of markets. Even we just recorded another episode where we were talking about Austin. There was a ton of overbuilding of apartments out there and potentially single family houses.
Pulling back 25%. So do you think it's possible that Austin pulls back 50%, a 50% market correction?
Values are, but once absorption happens, you're going to see rent growth again. I mean, you and I have properties in Oklahoma City, which isn't an Austin type market. It's probably more of like a Midwest type market. But I'm seeing a significant rent premium over the last 3 years as I've been involved with that market. So it just comes down to economics 101. You've got supply and demand fundamentals, and you've got the printing of money, which is going to continue to grow. I mean, I think 2026, it's not going to be rocket ship, but I think it's going to be steady Eddie. And yes, I think that we're just talking about just a national average in general. I do agree. Like ultimately, I really don't give a shit because I'm buying on in-place fundamentals on commercial assets, in-place rents, in-place expenses, and the property's going to... Yeah, it's going to take care of itself. I mean, if we're arm wrestling over what nationally, what housing values are going to do, which is kind of kind of a ridiculous number anyway. I would say overall housing values are going to be up. And I'm right. It's just wrong.
If you like what you're hearing so far and you are not making at least $120,000 a year with cash flow real estate or have millions of dollars in equity, come check out our 0 to 100 elite community. The link is below. Check it out.
I don't necessarily care for my investing. I care for the health of the country. I think that a lot of equity is tied up in housing. That trickles down to like our economic health. I also don't want to see prices go up so high to where, back in the day, it would be 1 or 2 times your income. Today, in some markets, it's 8 to 10 times. So I think about my kids or my kids' kids. Like, you also don't want to see, the rich get so rich that the poor get even poorer. I don't like that economic divide. So that in that regard, I care just sort of globally, but my own investing, I don't really pay a whole lot of attention to it. I don't think you're going to see housing prices go 50% down across the entire market. Now, I do think in the places like Austin, for example, where prices grew the fastest, you'll see prices go down the most, because it's cause and effect. It's what goes down or what goes up must come down, and a lot of times you'll see that oscillation in these really fast, aggressive speculative markets. They'll also overcorrect the other way. Most markets, though, I think you'll just see a softening and a slowing until absorption hits, and until we have basically a crossroads where seller prices hit buyers' expectations. And so, yeah, I think it's more of a softening in most markets, a temporary softening, and maybe a further decline in like markets like Phoenix and Austin.
When I hear you both speak and I think about my own opinion on this, I can't help but I feel like we all have this attitude of like, we don't really care. And I realize the reason, and I don't want to say that we don't care on a large scale, or we don't care about, the cost of living for someone, or, prices being unaffordable. But I realize as long-term buy and hold investors, the term there is long term. And so people get really hyper focused on, oh, what's going to happen in 2026? What's going to happen in Q1, Q2, Q3? What's going to happen next year? But, when I think about long-term buy and hold cash flow real estate, I'm thinking like 5, 10, 20, 30 years. Like, you hold an asset, you buy real estate on fundamentals, and you hold that asset. Like, you're setting yourself up for life. I mean, you have cash flow, you're going to build equity over time. And yet, even though real estate goes up and down, you can draw a pretty straight line, up and to the right. Like, real estate over time does go up in value, even though there's dips, and so does rent. So I think that, even though hearing you guys speak like, yeah, real estate might go up or it might go down, I think part of the reason that we don't have this strong emotional attachment to it is because we know long term, we're not worried about 2026. In 2036, we're probably going to be kicking ass because we bought real estate.
We won't give a shit about what 2026 was doing. I agree. And I think, how do you hold long term? You just buy on in-place fundamentals and you stress test the asset, make sure you can have vacancy hits, expense hits. And I think the moat and the gas that allows you to hold these assets is just cash flow, which ties back to what we talk about all day long in our book and our mastermind. Buy cash flow real estate, gives you lifestyle, but also allows you to hold these assets to weather some of these ups and downs that you're going to get nationally or in different local markets.
Well, I'll say one last thing. I think that if your economic situation depends on predicting the market, then you're going to care a lot. But if your economic situation, your growth of cash flow and equity doesn't depend on the market, then you don't care. And so it depends on what game you're playing. If you're a flipper, you need to care. You need to care about absorption, supply, demand, prices, where things are going. You need to understand that, because if you have a portfolio that you need to flip for a profit, that matters, and you don't want to get caught with your pants down. For us, we don't play that game. We don't play I need to understand where interest rates are going and where certain markets are going. Long-term investing for cash flow gets you out of all of that, and you start to play an entirely different game, a game of forced appreciation, cash flow. Make sure you have solid DSCR. It's a totally different game. So the attention to predicting markets is not as important.